Well, we're recording here.
Oh, we are. Hey, welcome to Two Vines.
It's between two vines.
Oh, that's it. Okay. So it's between two vines. We got
Vines.
All right. You probably have a question for me, I bet.
Okay, well, like I mentioned before, I just moved here from Canada, and I guess I need to establish my credit here.
Oh yeah, absolutely.
I'm not too sure about that. What do I need to know?
Well, credit is kind of a tricky thing, and not a lot of people actually understand how credit works. So, being in lending for so many years, I got to see all kinds of credit. And if you want to buy a house, you have to have fairly decent credit. Usually, between it's 620 and above, you're going to be able to find a house. Now, if it's below 620, it gets tougher. There's fewer programs you're going to qualify. 580 is really kind of the cutoff. So the numbers, what do the numbers mean? No one really knows really what it's a kind of a tightly guarded secret. Yes, they do that for a purpose so you can't manipulate your scores. But we do know how you can kind of manipulate them to improve them.
Okay, I'm intrigued. Tell me more.
All right. Number one, pay your bills on time. Do not let them go more than 30 days late. You get a 30-day late, your credit goes down. You keep constant credit. So if you have, how many credit cards do you have?
Two.
Keep them. Do not, even if you have like a high interest rate one, don't get rid of it. Just keep it, because credit looks at history also. So if you have a long-term history with a credit card, keep it. You don't have to have, credit on it,
I don't have to carry a balance.
No. But it does give you better credit if you have a small balance versus no balance at all. You know why?
No.
Because you have the ability to use that versus using it too much or too little.
Okay.
So if you stay in between that 10 and 30%, your scores are actually going to go up. So let's just take some easy numbers. Say you have a credit card has a credit limit of $1,000. You want to try to maintain $100 to $300 on that credit card and maintain payments for that. That's going to give you your best scores. You go up over that 30% of that credit balance, your scores are going to go down because you're using too much of that credit. The credit scores like to kind of stay in that 10 to 30% range to get you the best scores.
So why do they give me a card with $1,000 limit if they really only want me to use $300 of it?
Well, you have the ability to use that, but I'm just telling you, you don't want to use all of it if you want to get your scores up where they need to be.
Okay.
So try to hover between 10 and 30% of your credit limit. And if you say you're averaging $500 a month, try to get them to come up on your credit limit to $1,500 then.
Okay.
And then hover around that. That's going to give you better scores. And then the other thing too that lowers your scores, not a lot of people know this, but every time you have your credit checked or pulled, it lowers your scores by about three points every time there's a hard pull. There's hard pulls and soft pulls. So a hard pull is if you're shopping for a car, a house, and a lender or a salesperson pulls your credit, and that's a hard pull. Now a soft pull is you have a credit card company that kind of maintains and watches your credit, or an insurance company. They'll do a soft pull to kind of check and see where you're at from time to time. Those are soft pulls. The other thing too is when you're buying a house or you're buying a car, you have a period of time to shop for something. So if you buy something and your credit's pulled 3 or 4 times in a short amount of period, like 2 or 3 days, it's not going to hurt you.
Okay.
But if the credit's pulled over a month span, it's going to hurt you. So be precise when you're looking at buying a car or a house or a big ticket item where they're pulling your credit. try to have all your credit pulled in a short window versus over a longer time frame.
Okay.
And that's going to stay on the record for, several years of how often you're pulling your credit.
Right.
And that's going to determine how much credit you're going to have access to too. So it's kind of tricky.
So it doesn't really matter how much I've got in the bank or how stable I've been in my employment. If I'm not having my credit checked and I'm keeping my credit cards with only 30% of my spending limit, then I should stay in good graces.
Yep. And then the other thing too is I've noticed throughout the years, people that have the best credit usually have one loan, which may be a car loan. They might have one mortgage, and they might have one or two credit cards. And the highest score you can get is 850. In the 25 years that I was lending, I did not see more than 5 or 6 people having more than 830 credit scores. I mean, if you have over 830, you got spectacular credit. I'd say it's rare to see somebody in the 800s. People that we lent to on a regular basis, typically we're in that 720 to 780 range. That's going to be your typical score. You get below that, you're going to start paying higher interest rates. So if you go below 720, your interest rates are going to be higher than somebody that's above that too. So that's why credit is so important when you're actually buying a house, because a percentage, or a 1/4% or 1/8% can make a difference if you're going to qualify or not for a particular house.
That's a lot of good information.
Yeah.
Lots to think about.
Lots to think about. But there's tons of articles out there about credit scores and stuff like that, but it's very important. And when you're looking at buying houses, make sure you have a good credit score or to qualify for the best rates.
Okay.
All right. Well, hopefully that was helpful.
Thank you. Yes, Steve, it was.
All right. We'll catch you guys next time.
Next time.
Toodaloo.
Not saying it.
It's not? No?
No.
I'm not going to turn it off until you say it.
I'm not saying it.
Come on.
Fine. Toodaloo.
All right.